But we begin this morning with Wall Street worries. The stock market has been on a downward-sloped roller coaster the last 2 weeks for the most part, dropping by more than 10%. That's considered a market correction, according to the experts. Now, the market has had up days as well, but the sudden drop has many people reworking their 401ks.
1/3 of my retirement is dependent on the stock market. This is, in some ways, a natural thing to happen and a good thing to happen, so I'm trying to trust it, but it still makes me a bit nervous.
That's the situation as many investors worry about an even bigger meltdown possibly ahead, and they also wonder how are they going to protect their nest eggs against that potential. Joining us now is J.J. Burns of the J.J. Burns Company, wealth advisory firm on Long Island, and welcome to the show, Mr. Burns.
Thanks, Richard. Glad to be here.
So what do you think is happening here, a correction or a meltdown?
I think you're really looking at more of an organic correction. And we're not looking at where we were back in 2008 as far as a financial meltdown. There's a lot of adjustments going on in the world economy. China is fast becoming a change from a manufacturing economy to more of a consumer-driven economy. Those changes cause a lot of disruption in other like economies around the region, not just China, but Asian economies or other emerging market economies as well. So there's a readjustment. And frankly, stock investors, most of their portfolios long-term are in stocks. So this adjustment is typically pretty healthy in how the adjustment goes on.
Yeah, you say organic, correction, but billions of dollars were lost. So a lot of people look at their statement and, frankly, they're freaking out. How does this compare historically? I mean, we just had in 2008, 2009, that big downturn. Right. How does this compare to that? I know there's been over 100 through the years, but most of them are only at 5–10%, and they recover within a few months. But then there's about a dozen that aren't, including the one in 2008. Yeah. How does this situation compare to that?
Our team's done quite a bit of analysis on this, and it's actually available on our website. But what's really important to note here is that when you go back to World War II, and we note this, is that there's been 75 corrections that have happened, and they pretty much have been between 5 and 10%, and they've lasted on average about 4 to 5 or 6 weeks. Then there's another set of corrections which happens about every 3 to 4 years, and this is very, very normal. Every 3 to 4 years, we're seeing corrections of 10 to 20%.
Which is where we're looking at right now, potentially.
Right. And we really haven't had one in nearly 7 years. So the S&P doesn't go straight up. Take a chart.
Does that mean that stocks are just overpriced then?
It doesn't. Price is one component of it, and it's relative in nature. What's important to kind of glean when you look at pricing is that it's not just all about pricing. Investors have to take a look at what is it that's driving valuations in the world. And that's really what's happening is there's different valuations going on in the world in different economies.
Well, let me talk about that. You mentioned China, and every time China comes up, people say, well, it really isn't something that threatens our economy long term, because for the most part, China sells us stuff that we buy. And yet, every time anything bad happens in China, our market drops. So what's going on there? How come, if it doesn't matter, it does matter, though?
Well, what matters is that China has been a manufacturing-based economy. And like I said before, it's moving to a more consumer-driven economy. But they're doing less. They're manufacturing less, which means that they're not buying as much, certainly in raw materials from other countries in the region, which their profitability is driven by China purchasing. So their economies are equally affected. And those economies are moving from a lower middle class to a middle class economy, which is also consumer driven. Another component, by the way, of why this is occurring is you have lower oil prices happening and a glut of oil in the world. And what that means is that other economies have to adjust those lower oil prices with supply chains working pretty efficiently.
So you see, the world economy is, we're all linked together. There's no way to escape that when something happens, here. If there's a little jiggle here, then all of a sudden there could be a big shake elsewhere. Let me ask you about our underlying economy, though. Is it solid?
It's not great. It's okay. Where we are in recovery right now since 2008 is we are at the new normal of what a recovery would look like after such a world financial crisis in 2008. That said, around the world, There's skilled jobs that have yet to be filled in Germany. A recent article came out, and this morning you have jobless rates actually moving down, which is great for the economy. More people are getting employed. You also have wages that are rising in this country.
Does that mean that the Federal Reserve is going to raise interest rates? Because that worries investors too, because we've had basically cheap credit for years.
Right. And that's actually kind of the good news about what's happening in this economy. If interest rates are poised to go higher, and we do think that the Federal Reserve will ultimately have to raise interest rates further, the reason why they have to raise interest rates further is they need some fodder for the next recession, that they're able to lower interest rates. So it's a good thing. But one point I want to make on this is that with low inflation in the United States, with a strong dollar, it's bringing in more dollars foreign-wise to this country. So you could argue that the American economy is okay. It's not the cleanest shirt in the dirty laundry, but it's doing okay.
So what are you telling your clients to do? Do you move into fixed income securities, bonds? Well, what's the right move here?
Right. So there's never really any one asset class that works perfectly in a client's portfolio. And I'm sure a lot of other people and advisors say this. They'll say, well, you know, stay diversified. You know, make sure you rebalance your portfolio. And a lot of advisors say that. But the reason why I say it is because it's true. It really does work. And by having 100% of your money in fixed income, that's probably not going to be the panacea, and certainly not having 100% of your money in stocks.
Unless perhaps you're near retirement.
But even if you're near retirement, people are living 15 to 25 years more during retirement, and people are retiring differently today. They're retiring with another passion. They might have left one job and gone into another, and they have time to invest their money, which means they're going to have more money in their stock portfolio.
Well, you've laid out the scenario for us. J.J. Burns with J.J. Burns & Company on Long Island. Thanks for stopping in with the latest thinking on what's going on with the markets. Certainly we'll be watching when the markets reopen on Tuesday. Thank you, sir.
Thank you.